Good morning, teacher. Here we're going to talk about Walgreens company. The members of our team is Ayala, Czwikla, Kobayashi, Smith, and Vera. About the company, Walgreens is an American company. It's the second largest pharmacy in the United States. It has 277 stores. It had been founded in Chicago 120 years ago. In 2014, the company agreed to purchase the remaining 55% of Switzerland-based Alliance Boots. Now, both companies merged together and now it's called Walgreens Boots Alliance, Inc. About the analysis of the company's strategy, according to the commercial strategy, Walgreens needs to be updated with all the technology, transforming the interactions with the company and keeping data. Combine the technology, often offering the customers a great experience, whether it's in the store or through the app. Has loyalty programs to reward the most engaged customers. According to the operative strategy, Walgreens needs to review the operating costs to make sure that the costs are spent efficiently, offer a quality product, speed their supply chain. In the financial strategy, due to the pandemic, we can see that the revenues decreased a lot in 2020, so they should increase the leverage in order to increase their profit. Also, the ROI is just 1.76, which is really low comparing to the other 10 years that we analyzed that was between 10 and 13%. They need to reduce their inventory because that have additional storage expenses, and also that will reduce their net income. According to the threats and opportunities to the company, the main competitors to Walgreens will be CVS, Rite Aid, and Walmart. CVS has 15 years of loyalty card data, has almost 10,000 locations and walk-in medical clinics. Rite Aid operated the first wellness store concept in 2011, and they have 1,174 wellness stores. And then we have Walmart, which is a big corporation. It's mainly a grocery store, but they also have a pharmacy section. They have access to a doctor, to a nurse in the establishment that we can help you when you need to buy medicine. And Walmart also recently opened a Wow Center offering lab, x-ray, dental, optical, all in one facility. So if Walgreens and Walmart are going to be successful in healthcare retail, getting together will keep them competitive with CVS. This is not real, this is just hypothetically in case this merge happens. One of the reasons is that Walmart has the efficiency and Walgreens has all the logistics. So this will increase Walgreens buying power and its profitability. Here we have a chart about the pharmacy market according to Forbes that was made in July 2020. We can see that the leading company in pharmacy market will be CVS that has the 24%, and then will be Walgreens itself that has 17% in the market. If Walgreens and Walmart merge together, both together will get the 22.49% of the market, which is really close to the 24.26 that CVS already has. This will be a really good competitor to CVS pharmacy. And with Walmart's efficiency that relates to Walgreens logistics, this deal can succeed.
Now we take a first look at the prepared Excel file for our company Walgreens to start the financial analysis. Here we have the vertical analysis and marked in red. The rows that stood out to us and are worth to take a closer look at. So here we see marked the gross profit, the operating income, and the net earnings. When we look at the second part, the current assets, there are the total current assets, total liabilities, and total equity. In these two charts, we can see the marked data from the Excel. On the left side, the gross profit is in comparison to the operating income and the net earnings. We can see that the gross profit decreased continuously since 2013, and this is probably because they have partnered in this year with Theranon, famous through Elizabeth Holmes, and later charged of being a fraud company. With this, operating income and net earnings naturally went down as well, especially since 2018. Later in the horizontal analysis, we will have a closer look at this year too and explain what happens there. I think interesting here is also the year 2014 and the following year, where we look at the difference between operating income and net earnings. In the right chart, we can already see an explanation for that. Here we can see in orange the total liabilities that were rising after 2014. That was caused by Walgreens becoming a subsidiary of Alliance Boots. This also caused the total equity to go down as well. When we look at the total current assets, we can see two big spikes, one in 2011, the other one in 2016. In both cases, Walgreens acquired other companies, so they needed extra cash to buy them. So in the vertical analysis, here we can already see that there's a lot of up and downs in Walgreens numbers. Now looking at the horizontal analysis, this impression is reinforced as well. For the horizontal analysis, we did the same procedure. First, we looked at what numbers are the most interesting ones to compare and to take a closer look at. Those are marked in red here as well. Here and also here. In this chart on the left, we have the sales, the operating income, and the net earnings. The sales in blue had a high in 2015 after buying the 55% of Alliance Boots that were left to buy. Operating income is very volatile based on the same reasons we saw in the vertical analysis, so because of acquiring other companies. But also after 2018, we see a strong drop into the negative percentages as well. This is probably based on bad publicity coming from a lot of different lawsuits from all sides against them, combined with fines they had to pay in this year. And in 2020, we see the repercussions of COVID-19 as well. The same trends we can see in the right chart, looking at total current assets, total liabilities, and total equity. In 2015, we have the same spike as we've seen before. In 2012 and 2017, we see the drop of total current assets because of the buying of the other companies. And then in 2020, again, the effect of COVID. Those were the two analyses, and now we have to look at the ratios. First, the liquidity ratio. In the chart, we can see the current ratio and the quick ratio. In 2016, there's a spike explained by the acquiring of the rival. And after this, we see the gap between those two is a lot closer, indicating that they have less inventory in that time frame. The chart on the right is showing this as well. Here we see in gray the total current assets, in blue accounts receivable, and in orange the inventory. We can see that there is not only a trend to less total current assets, but also in less inventory from 2011 to 2020. This is probably caused by their expanding in e-commerce.
Okay, this is the cost of capital of company Walgreens in 2010 plus 2020. The WACC it's increasing, like in these 10 years. It's difficult for the company. In 2010 are 2.71%, and in 2020 are 10.60%. No? This is the graphic with WACC with KA. The cost of capital rising indicates less profitability, could be caused by a bias. And this is a graphic for WACC and the ROIC. It continues positive. Walgreens creating value, a lot of value in 2016 and after. The cost of capital versus the ROA. In the following graph, we see that the WACC until 2017 was lower than return of assets ROA, which implies that until the mentioned year, the company Walgreens was creating value with a healthy debt, adequate for cash flow, and adequate in viable return expected with the shareholders for the profitability of their assets. After 2017, we observe the WACC becomes larger and the return of assets ROA begins to fall. This is due to the fact the debts with third parties in the short and long term they have been increasing. Debts are not reflected in a business growth, no? And this is the table of WACC, ROA, operating income, short and long-term debts for the years, and uh, we see the short long-term debt uh, are increasing in these years now, and the operating income uh, looks good, but decreasing in the 2020. No, it's a very high decrease, and the ROA and it's the reason for the WACs are increased. No, it's that so of one of more important reasons. No, because the debts with the banks are increasing in these years. No, um, okay. Mm, thanks.
In this part, that is financial performance measures, we have a key here an extract of the Excel form. So we can look about some indicators as EBITDA. We have also put the EBITDA, vertical analysis, NOPAT, ROIC, and EVA. So we are gonna talk about each one of them, and I wanna start talking about the EBITDA. EBITDA since 2011 has a lower variation. It seems here in the chart of growth of a total of minus 2.29%. So it's like increasing, decreasing, increasing, decreasing, increasing, decreasing, but at average it has a decrease of minus 2.29%. Then, and this evaluates the business valuation before taxes, depreciation, and amortization. The NOPAT is constantly increasing among the years and is basically measured the profitability, assuming that the company doesn't have leverage, right? It doesn't count the leverage in the NOPAT. So it's increasing, but in the last year, it's very low because of the COVID-19 disease that affect this retail company. Then the ROIC has an average increase over return on investment and also generates higher returns on investments than the cost of capital for those investments. That's what it's mean. So it's generate a more return of investment than the cost of capital of these investments. So we compare it to the WACC and it's higher than the WACC. Also the EVA, it's positive and it's increasing over the years, except for 2020 that it has a decrease. So that's not good because of the situation, right? Of the pandemic. So that's why this indicator it's a little lower in comparing with the NAPA 2 and also with the ROIC in the last year, it seems a decrease in the value. Then analyze the possible risk of investing in the company. Well, due to the pandemic, most of retail's business or companies are really affected. So there is a risk because we don't know when the economy is gonna return to what it was. But now from the vaccination, the COVID-19 is reducing, principally in the US. It has good indicators of returning to that it was before. So in the income statement, we see that the net income is decreased a very low. It's very low compared to the past years, and it's because of the COVID-19. Then the balance sheet is also that the liabilities are growing. The assets are a little decreasing, but the liabilities has a higher tendency of increasing, so that's not good. The liquidity ratios are not good. The current ratio are not really good, are decreasing because of this year, so that's another risk. The principal risk here is that the retail business is highly affected for COVID-19. Also, profitability ratios reducing a lot. It's almost 19% last year, and cash conversion cycle has increased. But what we want to say about this is that in the situations of risk of lower, there are the new opportunities of investment. So it will be a little risky, but it can be a good option for investment.
Okay, so analyze the financing structure of the company. Is it similar to other companies in the market? Well, for this part, we made a table with the basic financial ratios, and we compared them between the Walgreens and the direct competitors that would be CVS Health and Cigna Express Scripts. So the financial ratios we took into account for this table were the quick ratio, which for Walgreens will be 0.28, which is normal for the industry, but still low. An earnings per share of 0.52, which is lower than the competitors, a price to earnings ratio of 73.37, which is massive compared to the other companies. The debt to equity ratio, that would be of 0.90, which is better than the other companies, and the return on equity, that would be 1.76%, which is very low and worse than the other companies, and the return on assets, that would be 0.63%, which is also worse than the other companies. So regarding the quick ratio, the ratios is of 0.28, which still is low. It means it's bad. This is because it's most likely that the company won't be able to pay off its current obligations using only liquid assets. This is because the quick ratio is well below 1. Also, this ratio is a result of low cash and cash equivalents and high current liabilities. So regarding the price to earnings ratio, it's massive due to the small EPS. This massive ratio means that the stock is overvalued and that investors, well, it's probably because investors are willing to pay a higher share price today because of the growth expectations they have for the company compared to the other companies in the market. Also, the EPS is low because of low net earnings and high shares outstanding inside the company. The low debt to equity ratio, it's better for the company because it means it's probable for shareholder equity to cover all of the outstanding debts in the event of a business downturn. This makes it a low risk for investors and a better investment. Also, this ratio, it's a result of the similar amount of financial debt and shareholders equity. So the ROE, it's very low compared to the other competitors, and this means that the company is not very efficient in generating profit, and it could mean that the management doesn't make good use of investors' money. This is why, because it's bad, and this ROE is due to the low net earnings and high equity. So the low ROE means that the company is not able to make maximum use of its assets to get more profits. And it's also due to the low net earnings, but high total assets. So explain the bonds the company used before. Should the company issue new bonds? If so, create the new bond prospectus. Well, so thanks to Market Insider, we were able to get the information of the bond for Walgreens. And we can see that it has a nominal value of 1,000, a coupon rate of 3.20%, which we divided by 2 to get the semi-annual coupon rate, which would be 1.60%. This is because the number of payments per year is 2. That's why in this column it says semesters. The bond rating was BBB according to S&P Global Ratings. BBB means it has an adequate capacity to meet its financial commitments. It was also issued on April 2020, and it has its maturity date on April 2030. But as we are past April 2021 today, we only would have 9 years, not 10 years, and that's why we have 18 semesters, not 20. So the issue volume would be of $500 million, and the issue quantity would be of 500,000. Also, taking into account the rating, the BBB rating basis points and the yield curve inside of the US, we were able to calculate these percentages that would result into the price we have now, that would be 239.12. With this price in the exercise, we could calculate the yield to maturity, which at first it was semi-annual, and we had 12.25%, which then transformed into the annual YTM would be 26.01%. This YTM, it's high, but it doesn't mean it's bad. It means that there is high returns, but there is also higher risk for the fund. It also means that the bond is being sold at a discount to its par value, and it could mean the company is most likely to default on its debts. This percentage of YTM is more attractive to investors that are willing to take a risk for higher returns. But we actually believe that perhaps a lower YTM of 20% could be more attractive for more investors due to the lower risk of default. For this, we will have to change some things like the coupon rate, which would transform into 8.40%, which semi-annual will be 4.20%. The number of payments per year would still be the same, and the bond rating we can't change because it's a rating that specialized companies give. So the company could be improved to get this rating, to get a better rating, which would then influence into the exercise greatly because of the percentages would change. But continuing with this exercise, the issue date would be on May 2021, and it would be, the maturity date would be to May 2028. It would only be 7 years, thus making it 14 semesters. And the issue volume and the issue quantity would be still the same. This will give us a YTM semi-annual of 9.70% and a YTM annual of 20.34%, which is lower than the bonds, and it doesn't change as much as other options that the bonds the company already has. Thanks.